the interest rate at 1% as we expected. However, it appears the market was not completely comfortable with the statements that were coming from the Fed that basically said they intend to keep the rate at 1% for a long time, or something to that effect. So I don't have the words quite right, but basically the indication was that the rates probably won't be increased until next summer at the earliest. The market doesn't really believe that because of the economic indicators are that there's very strong economic growth, perhaps as high as 6% in the U.S. economy, which means that perhaps the Fed will have to raise the rates before next summer. So it's sort of interesting. They were anticipating this statement, but they don't really believe what he said. So I'd just like to finish our discussion of fundamental analysis with an illustration of how a fundamentalist might look at exchange rates. And this concept is called purchasing power parity theorem of exchange rates. It's explained in the book. We touched on it on Monday. And the basic idea is that if an exchange rate is in equilibrium, then you should be able to move from one country to the other. And after you convert your currency into the foreign currency, the prices you paid would be equivalent to those back home. In other words, if a hotel room in San Francisco costs $200 a night, and you fly to Tokyo and convert your dollars to yen and rent a room in a very similar hotel with the same amenities, the dollar cost to you, although you're paying in yen, the dollar cost ought to be $200. If it's higher or lower than that, then you might argue that the yen is overvalued or undervalued. So that's the basic idea, although it applies to more than just one commodity. The theory applies to the whole basket of commodities that most consumers will typically purchase in a year. The Economist magazine has picked up on this idea, and they have a little fun with it. Every 6 months or so, the Economist magazine publishes what they call the Big Mac Index, and it was even alluded to in the video. This concept is spread well beyond the Economist magazine, but they're the ones who started it. Okay, and the basic idea is the Big Mac is a homogeneous product. If you buy a Big Mac in Moscow or in Davis, they're hard to find in Davis, but I know where they are. Davis or New York, Melbourne, Sydney, it's pretty much the same wherever you go. That's why I don't eat Big Macs when I travel, but they're pretty much the same wherever you go. So it's a homogeneous product, so it meets that category. So it's interesting to see what a Big Mac costs in various countries, and the economists can easily sample that. They simply send somebody down to McDonald's, find the price of a Big Mac, and then they publish these data and use that to determine whether or not exchange rates overvalued or undervalued. And for several months now, they have been arguing that the US dollar is overvalued based on the Big Mac index, although it's tongue-in-cheek because everybody knows that you can't just take the price of a hamburger. But it illustrates the concept of purchasing power parity. So the example I give you is that of a Big Mac in the US costing $2.30. We know that it's produced in many different countries. And so now we travel overseas and determine what it might cost in a foreign country. So let's suppose that your first stop is Japan. Let's see, here we go. Your first stop is Japan. Sorry, that color is not... let's see, here we go. So you go to Japan, you exit the airplane, and you convert your dollars to yen, and the exchange rate is 100 to 1. So for every dollar, you get 100 yen. You take a cab downtown, and you stop at McDonald's. You're hungry. They don't feed you on the airplanes anymore, right? And you walk in and you order a Big Mac, and the price is 391 yen. 391 yen, which seems very expensive compared to the price in Davis of $2.30. So the question is that exchange rate of 100 to 1, is that an equilibrium rate? Well, it's not, because it's very easy given that it's 100 to 1. The price that you're paying, and you don't even need a calculator, is $3.91 in US dollars. So the price of a Big Mac is 391 yen. That's $3.91. So it's much larger than the price at home, right? So the question is, at what exchange rate would these two prices be identical? And that's the PPP rate. The price is 391 yen in Tokyo. It's $2.30 in Davis. So we have to solve for the PPP rate. You know that the rate you get at the airport is not the PPP rate, because that gives you a much higher price in dollars. If we solve for x, well, we get 170 to 1. 170 yen per dollar, which means that if the exchange rate was 170, so when you exited the plane, for every dollar you got 170 yen, and then you go down and stop at McDonald's and buy your hamburger, you're a much happier camper, because when you pull out your calculator and check the price, well, it turns out it's the same price as at home, $2.30. So that's not bad. So if the exchange rate were 170 to 1, then the prices would be identical. So that's what we call the PPP rate. And given that the market rate is 100 to 1, the implied PPP rate is 170 to 1, then we see that the yen is overvalued to the tune of 70%. Okay? If it were in equilibrium, it would be 170 to 1. It's much stronger than that. It's 100 to 1. Right? If you're only getting 100 yen per $1, that's a stronger yen than if you're getting 170. So it's overvalued to the tune of 70%. Okay, any questions on how I came up with the 170? It's the exchange rate at which the prices would be identical. All right. So then you continue on down to Sydney, and when you exit the airport, your exchange that you receive is $1.42 Australian per US dollar, $1.42 Australian per US dollar. So we go through the same set of calculations here. You see that the price of a Big Mac in Australia is $2.45 Australian dollars. So if it's $2.45 Australian dollars, and it's $2.30 in Davis in US dollars, then we have to solve for x, where x is the PPP rate. At what exchange rate would these prices be identical? You notice that the rate you're getting at the bank of $1.42 converts into a local price in Australia of $1.72. So when you go through the transaction in Australia, you pay $2.45 Australian for the hamburger, but you received $1.42 Australian for every dollar at the exchange rate booth. So in fact, your hamburger is only costing $1.72. So it's a heck of a deal, right? You might even order a second one. It's cheap. It's cheap because the dollar is strong relative to the Aussie dollar, and you want to calculate the PPP rate. Well, if we solve for x, we'd get $1.07. So if the exchange rate were $1.07, then the price in Sydney would be identical to the price in Davis. They'd both be $2.30, which means that the Australian dollar is undervalued to the tune of about 25% if you compare the actual exchange rate to the implied PPP rate. Okay? So that's an important concept in currency markets. It's a long-term concept, as most fundamental analysis is. If you've been paying attention to the currency markets, you can look beyond the Big Mac index and find actual PPP rates published by the International Monetary Fund, where there's serious research that goes into calculating the rate. And they will estimate whether a currency is over or undervalued. And according to economic theory, if it is, it will eventually come back into line according to its PPP rate. So if you believe the Big Mac index as an indicator, this would say that the Japanese yen is going to fall and the Australian dollar is going to rise, which is exactly what happened. Freya? So the question is, what if some of the ingredients for the hamburger, such as tomatoes, drove up the price? So tomatoes are very expensive in Japan, and if that drove up the price. But that really illustrates the fact that just using a hamburger is not a good idea if you're actually speculating on the market, because also the price of beef in Japan is higher than world levels because they have a tariff of about 60%. So you need to look at an entire basket of currencies rather than just looking at one commodity. And that's a good reason why you don't want to just look at one commodity. But they have a lot of fun with it, and actually it's surprising over the years. The index has given you a rough idea of the extent to which currencies could move. There's a question? Did you have a question? No? Go ahead.
When they figure out the price of Big Mac in Japan or Australia, is that the average price of Big Mac? Or the price they're investing on?
Well, you guys are getting technical now. I don't know how they do it, to be honest with you. I suspect the price of a Big Mac is the same throughout Tokyo, but I don't know. Like I said, I don't go into McDonald's when I'm in Tokyo. But pardon? Should be, yeah. Should be the same price throughout the city. I don't know. Does anybody know? Price of a Big Mac different in Davis than it is in New York City? I have no idea. Is it? Okay. Well, you didn't go to McDonald's, did you? Did you go into McDonald's?
Yeah, don't ask me why.
Okay. I was going to say, I thought they had plenty of great restaurants in New York. That wouldn't surprise me because, just rents and so on. In fact, I was reading an interesting article the other day about the European Union. And as you know, they've gone to a single currency. About a year ago, I guess, is when they officially moved. It was a transition period. But now they have a single currency. And you would think that a homogeneous good like a Big Mac or a Sony 19-inch television or automobile that's imported, we can identify certain homogeneous goods. And you'd think they would cost roughly the same in Germany, in France, and Italy, now that they have a single currency. And some research has been done that finds that actually there's a lot of discrepancy. And in fact, they commented on the U.S., not on Big Macs, but they commented on the law of one price in the U.S. I mean, this is really the law of one price, right? The law of one price says for a given commodity, good, whatever, there's really only one price because arbitrage will ensure that the price in Davis is equivalent to the price in New York. Now, if there's some transportation costs or some tariffs, there's some adjustment, but there's really just one price. So this research demonstrated that in the United States, the law of one price pretty much holds. So a 19-inch television in San Francisco might cost you more or less the same as it does in Los Angeles or New Orleans or whatever, but not in Europe. So that's sort of interesting. And the expectation was with a single currency, you'd have this convergence, but it hasn't happened yet. 5%. The 25%? Yeah, that's the difference between the market rate, the exchange rate, the second column there, and the implied rate. Okay. That should work out. I don't have a calculator with me, but okay. You see what I'm saying? We know what the market rate is, Okay, the market rate's $1.42. The implied rate is $1.07, and so the 25% reflects the difference between those two. Yes. 35%? It's it should be relative to the current rate. Executive.
It should be 75%.
Yeah, so 25%. Yeah, it depends what you use as a base. But let's use the current rate as a base, okay? Thanks. That's what you got too, using the current rate? Yeah.
So do they know why the prices vary in the European Union?
Must be lack of competition. Some differences in tax rates. You know, you mentioned the Big Mac's more expensive in New York. There's property taxes are maybe higher in New York than they are here. So there are those factors at work, but you'd expect a lot more convergence in what you've seen. Okay, let's shift to Chapter 6. And I hope to start Chapter 7 by Friday. I may get done 6 today, I may not. So please read Chapter 7. Chapter 7 is perhaps the most important chapter in this class. And we're building up to a discussion of hedging, which is really critical. And it will greatly facilitate things if you read ahead, okay? I appreciate questions in the class. It seems like many of you don't have any questions, which worries me somewhat, and I don't know why. Maybe you're reading ahead and you understand everything, or you're not reading ahead. But certainly once we get into hedging, we have to cover that material. After today's lecture, the course becomes much more difficult. Once we get into options, the options material is very technical, it's very difficult, and we're really building on this knowledge base that we now have. You now have a pretty good understanding of how these markets work, and so we'll talk about hedging, which is one of the most important economic rationales for the market. So before we get there, let's talk about chartists. And as I told you the other day, chartists are important in the marketplace, but it's also true that the theory of random walk tends to describe price behavior, and as a result, I don't have a lot of faith in charting techniques. But here's my good friend Ken Roberts. I talk about Ken in the book. This is his website, www.kenroberts.net. Ken is a multimillionaire. He owns a beautiful home in Oregon, and he smokes really big cigars, and you know, he's lots of money. And he's made his money selling trading techniques, selling videos and books. So you can have a look at Ken's website sometime. But here's the entree to his website, and keep in mind that he has a large following and sells a lot of different trading approaches. So I don't know if you can read this or not, but he says if all the money in America were evenly distributed among every adult, in other words, you take all the wealth and you reallocate it, so everybody, you just divide by n. Everybody gets the same amount. Within a very short time period, we'd soon have lower, middle, and upper classes. So he said if you redistributed it, it wouldn't take long before, again, we have these different classes. Studies prove time and time again that anybody who wins $1 million in a lottery is worse off than before they won the money. Okay, well, hope you don't catch me buying lottery tickets this weekend, but I tend to buy them once in a while. I just want to defy Ken. I hypothesize that if I win $1 million in the lottery, I'm going to be better off rather than worse off, but not according to him. So he says, why is this? Well, it's because most people don't get it. Most people just don't get it. And he argues that he can show you how to get it, how to come out smelling like a rose. And he talks about a friend of his, this millionaire, who said if he lost all of his money today, just give me a lawnmower and I'll easily make $100,000 this year and I'll easily make my million back. And this friend of his gets it, right? He knows how to get rich. So this is the sort of person that Ken's interested in. If this appeals to you, you need to give him a call. And he says, if you get it, you're going to love it. I have to show you, and you probably won't get much sleep tonight. Okay? So there's an example of a technical trader. And he can be very convincing. Yes?
Does he ever specify what he said he made most of his money off of selling his books and videos?
No, that's a secret.
But does he ever specify how much money he made on
I've read, there was an article about him in one of these money magazines 3 or 4 years ago, and it's lots of money. I mean, I don't know if he has 60 million or 100 million, but he has lots of money. Yeah, and he used to be an Amway salesman, and there are a lot of rich Amway salesmen too, but he just used those techniques in futures. And I mean, there's no question he makes his money selling trading techniques, not trading. As I said, there are lots of people with disposable income that they look at a website like this or they see a video and they go, wow, you know, I've got to call this guy. I really like this character. And yeah, I want to get in on this action, right? And there's another character that's a friend of Ken's called Jake Bernstein. And I'll show you a little video clip on Friday of Jake. If you're ever up in the middle of the night watching TV, you've probably run into Jake. He has these infomercials late at night telling you how you can get rich trading in the futures market. But I know that Ken's a lot richer than I am, that's for sure. So here's some examples of what attracts individuals into technical analysis. And if you pick up magazines, there's a futures magazine, or you search the web, you'll run into headlines like this, Cycle Buster, that might be a trading program, Market Masters, Power Traders, guaranteeing profits of 500%, 1,000% is nothing unusual in this industry. Okay? The CFTC makes them put a little disclaimer on the bottom in very small print, but most people don't get that far. So what is technical analysis all about? I mean, I could devote an entire course to this topic, but I don't see the point of it. Rather, I choose just to give you a rough idea of what it's about. And the truth of the matter is, a lot of the technical programs are very, very similar. But the people selling them will go to great lengths to convince you that they have something that's unique. And I mean, you have to ask the question, if this is so wonderful, why don't you just trade yourself, Ken, and be quiet, and keep your millions. You don't need to be out on the stump selling this stuff for $2,000 a video. So right away you get suspicious that it can't possibly be as good as what you're saying it is. And the reason is that it's necessary for these individuals to sort of disguise what they're doing, except when it comes to the trading funds that I mentioned, the commodity funds, and I'll talk about those later. And I've actually read through some of they have to put out a prospectus if you're selling shares in this commodity fund. And you read through the prospecti, I guess, and it's amazing how similar they are. So these are the types of strategies that they use. So I can break it down into 4 techniques. There's patterns on price charts, where this is inherited from the good old days where we didn't have computers. You literally look at price charts and try and identify patterns that recur. I sent you an email yesterday that looked at some technical analysis, and I'll just give you a quote from there. The article I sent you went through the various markets. It was talking about the gold market. And it says the gold market spiked sharply higher, and it appears that it's forming a double top. Okay, so the gold market is forming a double top. I bet you didn't know that before you read the article, right? So what the heck is a double top? Well, we'll look at it at a gold chart here in a minute. So you look for patterns on price charts. If it's forming a double top, you've seen that before, and you know that once the double top is formed, then the market's going to break out, and that's when you need to buy or sell. So literally, it's very subjective. They're looking at historical prices, and they're looking for patterns that they have seen before, and they use the pattern as an indicator of a market move in one direction or the other. So there's the charting. That's the pure charting. The second one is trend following methods. It's more objective. This is where the personal computers are very useful. And it can be as simple as calculating moving averages. And I'll explain that in a second. Or using regression analysis, where you're basically trying to find out what the trend is. You know, the old adage in charting is the trend is your friend. You want to be in on a trending market, and that's where they make the money, is if the markets follow long-term trends. If it's jumping all over the place, it's impossible to make any money with technical approaches. Third technique, character of market analysis, and I'll give you some examples of each of these. The example I mentioned here is oscillator, and I'll show you a picture of an oscillator. Basically, a character of market analysis tries to bring some psychology into play. You know, I've emphasized that technicians only look at historical prices, but they also look at volume and open interest. And so they might combine historical prices, volume, and open interest to try and determine the psychology in the market. And a lot of character of market analyses will take a contrarian approach. If everybody thinks the price of cattle is going up, then it's time to go short because the market is overbought. If everybody's in on the long side, then you want to go short because that market's going to come crashing down. That's essentially the approach they use. And then the fourth area is very obscure, and an example is the Elliott wave theory. These are very long-run structural theories where literally these traders will go back 100 years. So they'll look at the price of wheat over the past 100 years, or the price of gold over the last 200 years. And they have these very complicated sets of chart patterns that they identify. A lot of it is based on work of somebody by the name of Ralph Elliott, who developed this theory in the stock market. And it's also used in futures markets to try and predict price changes. So I'll just go through each of these four and try to give you an example, and then I will flip to the Wall Street Journal and we'll look at what a double top looks like and so on. So here's a simple example. You have the bar chart, which you're familiar with. This was August 2003 gold. As you know, in the bar chart, the vertical line shows the difference between the high and the low, and then the horizontal line shows the close. So you simply keep track of prices. You know, you have each day on the horizontal axis, the price here. So this is the range between the high and the low and the close. You keep track of that, and you look for patterns. So here's a pattern. We have an upward flag, which may not be so obvious until they draw the black lines in. And so we formed this upward flag, and now it's time to buy. So if you had a technician here, he or she would tell you that they knew the price was going to rise on May 1st because an upward flag had formed. And isn't it obvious now when you look back? So I could bring this chart into a room and say, well, based on my research back in April, May, I knew the price of gold was going to rise because I've seen this many times before. This flag was formed, and it broke out of that pattern, and that was time to buy. And if you had only listened to me, you would have made $40 an ounce in the gold market. So that's one example of why you should buy my video, right? You're familiar with regression analysis from 106. It's another technique that you can use in charting to identify a trend. There was another statement in the email I sent you from the cotton market, and I found this one sort of amusing. December cotton continues to gap, and the higher we go, the market's going parabolic. So the market's going parabolic on us. It's rising so rapidly, and you could estimate that with a nonlinear regression line like the following. Okay, so there are plenty of examples in the book. I don't expect you to know these different formations. I expect you to know what the four categories are and to be able to explain moving averages or an oscillator, the examples that I show you. Okay, I'm not really going to dwell too much on these historical chart patterns. So a moving average is a very simple concept. It's basically an updated average. So if you have a 5-day moving average, you just take the closing prices for the last 5 days today, sum them up, and divide by 5. Tomorrow you take tomorrow's closing price and you subtract the one from 6 days ago. So that one drops off. So you're just updating the average. And this is a very common technique used by technicians, and there are variations on it. They'll use weighted moving averages, and maybe Ken Roberts has found that a 12-day moving average works best, but Jake Bernstein says no, you have to use an 18-day moving average. I mean, who knows? But moving averages are easy to do with a personal computer, and it's basically a way of smoothing the price series. That's all it's doing. Remember, the chartists they're always trying to identify a trend. That's the only way they can make money, right? Is if the market's trending. So they're always trying to identify a trend. And when you look at a price chart, there's a lot of noise there. And what a moving average will do is it smooths out the noise for you and helps you identify whether or not there's a trend. And the longer the number of days included in your moving average, the more smooth the price will be. So if you're looking at an 18-day moving average like Jake might versus a 4-day moving average, well, the 18-day moving average is going to be a much smoother line. It's going to take more noise out. For example, if you have a 25-day moving average, every new bit of information only adds 4% to the price change because you have 25 numbers in your numerator. If you have a 5-day moving average, then if you add today's closing price, well, that gets a weight of 20%. So it's weighted much heavier, hence it will be less smooth. The thing with moving averages is they always lag behind the price change. So if the price is rising, the moving average will be below it, and then when the price turns, they will cross, and so on. And I'll show you a picture of how they're used. This picture, let's see, now I've changed the color to white. I have to go back to black. Okay, here we go. So the blue line is the futures price. So the futures price is chopping around, and the black thick line is a 10-day moving average. So you can see it's a little bit smoother. It's not so obvious on this graph, but I'll show you some others in a minute. But the basic idea with the moving average is, and let's start right here. The basic idea is the following. When the price is rising, as it is here, the futures price is going up. The moving average will also rise, but it's going to lag, and it's going to be below the price. So as the price goes up, the moving average goes up. They'll both move up together. And so as we move higher and higher, the moving average is trailing along. And then right here, the price comes crashing down. Okay, this was September heating oil. So the futures price starts to drop. But because the moving average is lagged the moving average continues to rise for a few days before it turns down because, as you know, we don't, this is a 10-day moving average, so each closing price only has a weight of 10%. But the point where the two cross, right there, that's a signal to a technician. So the technician would, in this case, they would get in the market down here. This would be taken as a buy signal because at that point, and we'll call that point number, well, let's call it B. That's a buy signal. At that point, the price crossed through the moving average from below. And up here, I'll call this a sell point. The price crossed through the moving average from above. So again, I could put this on my video and show you this graph, and I wouldn't tell you what it was necessarily, but it's a simple 10-day moving average. And if you'd only listened to me in the case of heating oil, last year, back in October 2002, I knew that the price of oil was going to rise because my technical trading rule told me it was going to rise. And what's your technical trading rule? Well, I've used a moving average. And when the price is below the moving average, then it crosses through. Well, that's an upward trend. We're starting a trend. So that's where I go long. I'd stay in the market. It goes from 66 cents all the way up to 80 cents. And then when it crossed and reversed, where I've put the other circle, that's where I went short. And so, this is an example of how you could make money with my system. But you see here where the market's chopping, you're not going to make anything. You're going to lose money because of your high commission fees, and you're just going to get in and out of the market every few days and get whipsawed to death. So it's not the case that moving averages are wonderful, except if you have this long period of trending prices. Do you get the basic idea of what the moving average is? Okay, here's a 50-day moving average. It's very smooth compared to the price. Same idea. The trading rule looks for when the price crosses the moving average. You could expand on that trading rule and make it different than Ken's by saying, well, it must cross and it must cross by X percent, or it must cross and stay above or below for more than 3 days before I get in the market. So we can think of ways to modify the rule, but the basic idea doesn't change. When the two cross, then we have a reversal in trends. Okay, so that's enough on moving averages. And I'll come back to the Wall Street Journal in a second where, by the way, if you subscribe to the Wall Street and you have it online, when you look at your charts down at the bottom, there are options where you can pick different technical rules. So click on one of those. You can pick an oscillator moving average and experiment with that, and you can see what I'm talking about at the bottom of each graph. And then you have to redraw the chart, of course. Okay? So the second area is called character of market analysis. As I said, the oscillator is very typical here. And this is where technicians can try to confuse you a little bit with the sophistication behind their oscillator. But there's only so many degrees of freedom here in terms of how you design an oscillator. So the idea here is we're looking for the quality of a price move. The psychology is coming in here. So not only are we looking at price movements, but we're looking for the quality of a move. Yes, the price is up today, but is that a strong signal that is going to continue, or is it a weak signal? And it might depend, who's trading. So there's different ways of assessing that. The simplest oscillator just looks at the percent price change over a given time period. So you look at the cattle market. We know that the cattle market has risen dramatically since July, right, because we closed the border. That price is up about 50% since July. That's a dramatic move. So it would put our oscillator off the charts. And if that's the case, then a contrarian would say that market's overbought. It's got to go down. I'm going to sell cattle. So you calculate a percent price change over a given number of days, whatever it is, 10 days, 18 days. Ken Roberts probably chooses his birthday. If he was born on January 15th, he'd use a 15-day oscillator. And he would think that, there's a reason for that. So we take the price change over the past 15 days. I hope nobody in here is related to Ken. He's not a bad guy. Oscillators are simply then using this price change to indicate whether the market's going to continue to rise or to fall. So this is what I'm referring to. And I have to keep changing the color. I'm sorry about that. Okay. So this is the past 30 days. Okay. So I was born on the 30th. I use a 30-day oscillator. Percent price change over past 30 days. Very simple, right? So this is the percent over here on the vertical axis, and this is time. So going back several months, I would look for a market where there's a relatively new contract, but it's been trading for 30 days. So I just take the price change over the past 30 days, and I find that it's minus whatever it is, 5%. So I plot that number there. And then continue as the days roll by to add to my oscillator. And then it starts to rise, and we get up here. And this might be 10%, okay? 10% price change. So I'd use my wife's birthday for that one, okay? So as we cross above the 0 and hit up to 10, I'm just watching this market, looking for a signal that it's overbought. So as soon as it hits that dashed line on top, that's my magic number, 10% price change over the last 30 days. The market's been rising. It's been going too fast, too quickly. It must be overbought. I'm going to sell. So this is a contrarian position. You're going against the grain. So even though it's been up sharply, that's when I would put in a sell order. Okay? And then I would hold that position until we got down here where it crossed the minus 10%, or I might have a different rule. Who knows? I wouldn't tell you anyway, right? I'd have a different rule where I would liquidate the position. And then, of course, if it got oversold, then I would go long. Yes?
So basically the -5 and the 10 are just your personal numbers that you
Exactly.
set up. Okay.
Yeah, yeah. With the oscillators, they're literally, if you start looking through the literature on technical analysis, a lot of these traders actually use oscillators. And they won't tell you exactly what these magic numbers are, right? But you just, as a trader, if you start using these yourself, you have to decide what your rules are. Do I want to use the past 30 days? Do I just take a simple percent price change? And then what sort of parameters am I going to put on the extent to which the price move indicates overbought or oversold? So, I'm just being silly when I'm giving you these birthdays and so on, but somehow you have to choose the number, right? And there's no secret rule, and I don't know how Ken chooses his number. I don't have a clue how Jake chooses his, but somehow they choose it and then try and argue that they found the secret. It's the same way I choose the lottery numbers, actually. Okay? Okay, structural theories. So these are more the long-term theories. This is where the chartists go really weird on us. There was a Russian economist called Kondratieff who looked for long-term price cycles, and he was interested in the effects of capitalism, and he believed that ultimately capitalism would be self-defeating. So he studied commodity markets over long periods of time and thought he had identified cycles. He wasn't a friend of Joseph Stalin. Not many people were. And because he was an economist, Stalin had his head off. He was thrown in jail. We never heard from him since. And the reason he was thrown in jail was because he really was passionate about these cycles. Okay? but he still has a large following because he developed an approach to estimating cycles. But the poor guy perished in prison. Okay. Another character is Ralph Elliott. As I said, Ralph started observing the stock market, and he was a very modest man because he wrote a book with the title Nature's Law, The Secret of the Universe. Okay? So he discovered how the universe works, and he thought that there were these natural cycles in biological processes, in markets, and so he knew how to predict what was going to happen with virtually anything in the universe, including the economy. And he liked this series of numbers called the Fibonacci series, named after an Italian mathematician, where each number is the sum of the previous two, right? So you have 1, 2, and then 3 is the sum of 1 and 2, 5 is the sum of 2 and 3, and so on. And what he did was, he took this Fibonacci series and then applied it to charts, and he would look at a set of price charts. He'd look at the price of gold for the last 100 years, and he would find all these waves. He'd find the 13 waves and the 55 waves, and somehow this all fit together and let you forecast which way the price was going. There have been hundreds of books written on the Elliott wave theory. There's probably 25 books written on how to use the Elliott wave theory to predict the price of gold, and people sell these books. And there are traders out there who subscribe today to, and there are lots of them, to Elliott wave methods of trading. Okay, you know what? I think I've run out of time. So Friday, I'll look at the Wall Street. But do me a favor and start reading the hedging chapter. It'll go much easier for all of us.